We have another red day following Friday where we saw the worst day in the S&P so far in 2025, and when we expand this to the last week, we can see a lot of red right across the market, with many names in fact down double digits, and we're also seeing market sentiment moving further and further into the fear, not too far off extreme fear, meaning many investors are starting to worry about the direction of the market over the shorter term. And as we've highlighted before, just last week the Bank of America said the S&P 500 could take a massive correction around the 40% mark, and just a few weeks ago Goldman Sachs came out and said that many hedge funds are betting billions on a market crash in Trump's America. In fact, when we look at the actual detail, they said in January alone investors had placed 10 times more bets on the US stocks falling than the equivalent bets that those shares would start to rise. We also saw from CNN at the beginning of the year where they said Wall Street had some very impressive performances in 2024, and they believe a lot of this could unravel in 2025, a year where they do sense a lot of volatility. And this is something again that is backed up by Goldman Sachs, who believe that global stocks in general are very vulnerable this year, and when they do talk about it, they say the very strong performances the S&P has had over the last 2 years, where they say they had some of the strongest returns in the overall index since 1928, and we're now in a situation where equities are pretty much priced in for perfection, and they see all of this leading to a lot of vulnerability, in which they do see a potential correction coming, whether or not that is by further rises in the bond yields, or in fact when we get disappointing earnings, or in fact the overall market health does start to deteriorate. And something we always like to mention on this channel is the average of the S&P, and right now we're looking at sitting at 30, which is very high, especially when the average over the last 50 years has sat somewhere in the 15 region mark. Now, probably no surprises as we do highlight this on a very consistent basis, but the overall market, as we can see on a forward-looking basis, does sit in the red, meaning that they are trading at significant numbers well above their own 5-year averages. If you're someone that likes to listen to analysts, for example Tom Lee, very popular, does seem to be on CNBC a lot, he says that the market sell-off which we saw earlier about DeepSeek was a complete overreaction and believes it is a great buying opportunity, something that we can see he also stands by right now after the market sell-off. Now today we want to cover 4 high quality stocks that we do believe are due for a rebound, that are trading at some very attractive valuations. The first one is Microsoft, which we can see is flat over the last year, but if we just look over the last month, this company is down more than 9%. No surprises that over the last 10 years, it has massively outperformed the S&P, up 822%, and now trades surprisingly towards its 52-week low, with Wall Street giving this a strong buy rating, as well as Seeking Alpha, who believe right now Microsoft is a buy. They also pay a dividend that does sit around the 0.81%, and as we have consistently shown, this is a company with green right across the board, meaning over the last 4 quarters, they've outperformed analyst estimates, 100% track record, and over the next 4 quarters, they do expect growth on a quarter-by-quarter basis. If we look to the next full year, based on the EPS, the company is trading around the 31 valuation on a forward P, and when we do compare that to the sector, no surprises, it does trade at a premium, sitting somewhere around the 27% mark, but for quality companies, you will need to pay a premium. Question is Microsoft a quality company? Do you believe that? And secondly, how much of a premium should you pay? Something we'll get to in our model later on. We also notice it does trade slightly lower than their own historical 5-year average, which could be a good gauge whether or not this company is undervalued. And we do also notice something very consistent, no matter which metric you look at for Microsoft. Yes, it does trade at a premium to the overall sector, but it actually trades at a slight discount to what their historical averages are. In terms of the growth, where they get a C rating, revenue year on year sitting at 15%, forward looking at 14%, which is significantly above the sector at 5 and 6 respectively. So yes, they do deserve that premium, and we do notice it is a little bit better as well than what they have recorded over the last 5 years. One thing that maybe lets them down is the earnings per share, only anticipated to grow at 13%, with the sector sitting around 14.9. However, on a historical basis, they aren't that far off, where we see it sit at 13.6. In terms of profitability, well, they do get an A+, Gross margin 70%, a lot better than the sector at 50%. It does sit a little bit higher than their 5-year of 69%. And bottom line, very impressive, 35%. That is very, very attractive to see. Sector medium, 4%, a lot lower, and they're not far off their own 5-year at 35%. And no surprises, this is a company that generates a significant amount of cash from operations, 126 billion, well above the sector at 100 million, and also well above their own 5-year average. So this company over time just continues to generate more and more cash. We also want to show you two valuation metrics before we do get into our own model. Now we're not looking at this in isolation, but the first thing we want to point out is that the expected price, the blue tunnel, is increasing over time. That is a good signal. And the second thing is right now the value based on the expected price does sit right at the bottom end. That is what we would call right now an undervaluation signal, and something we've already highlighted just earlier on. The company does trade at a forward P lower than the historical average. Whilst you may not consider that a straight undervaluation signal, it is something that we would say warrants further investigation. The other thing to note here is institutional aspect sitting at 71%. Yes, they have sold over the last 12 months 116 billion, but they've been buying a significant amount more. Not only that, in the most recent quarter, institutions bought twice as much shares than they sold, and therefore we would say right now institutions are clearly very, very bullish on Microsoft overall. Now our intrinsic value at $488 is derived from the DCF model. Now we'll show you how we got there with the free cash flow year on year. Average growth 14%, we've got around 16 in line with analyst targets. Now we also notice we have a low, medium and high growth rate. Now numbers are subjective, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Microsoft or any others. But based on 16% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, 488 indicating 21% upside. Now we'll show you for those that are a bit more conservative at the 14% point, 424 upside around 5%, so you could argue right now baked into the numbers is around 14 to 13% growth moving forwards, and for those that are a lot more optimistic at the 18%, $561 indicating 39% upside. Now we'll take the medium rate as we typically do on this channel, where we're not just done there because we always add an MOS, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at around $439, then we keep going till it's near the current trading price. Now, not at 20% yet, but what you are getting for what we would say is a high-quality Mag 7 company, 15 to 20% MOS. Wall Street themselves, we saw the very strong buy rating. $511 is where they see this over the next year, translating to 27% upside. And as we have discussed in other episodes, the S&P, based on analysts, do see it only growing by around 9 to 10%. So this is definitely one that analysts believe will outperform the S&P for at least in 2025. Now, before we jump into the next one, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and grab a copy right now of 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can also grab a recently released copy of 32 stocks that Wall Street themselves believe have the most upside right now in the S&P. So click below, you can sign up and read straight away. The next one we move on to is Amazon, which is up 27% over the last year. Over the last 10 years, more than 1,000%, massively outperforming the S&P. Just over the last month, similar to Microsoft, down 9%, and right now is pulled back from the all-time highs of $243. Both Wall Street and Quant giving this a strong buy, Seeking Alpha giving this a buy 3.96 out of 5. If we take a look at their earnings, another one very similar to Microsoft, where we see green right across the board, and based on December 2025 earnings per share, the forward P does come out to around 34. Again, a one that is very similar in essence, that it is trading at a massive premium to the overall market, but when we compare it to the 5-year average of Amazon at 177, it is trading 81% lower, and something that you can see reoccurring no matter what valuation metric you look at. Amazon right now trading at a severe premium to the overall market, but actually cheaper value-wise than over the last 5 years. In terms of growth, they do get an A-, revenue year on year and forward-looking over the next 12 months in the 10 to 11% region, a lot better than the sector at the low single digit, but it is lower than the 5 years at the 20% and 17% respectively. In terms of over the next 3 to 5, earnings per share is anticipated to grow very strongly, 22%, with the sector at 10.9, but lower than what we can see over the last 5 years at 31.3. Profitability, very impressive at an A+, 49% gross margin, a lot better than the sector at 37 and their own historicals of 43. Bottom line, same to be said, 9.3, above the sector at 4.3, also above the 5-year of 4.6, and very similar to Microsoft, generating a massive amount of cash from operations, 116 billion, well above the sector at 286 million, and nearly double their own 5-year of 63 billion. We also want to point out that institutional aspect is fairly high at 72%, and whilst we see 48 billion worth of sales, we see 132 billion worth of buys, and again, very similar to Microsoft, more than double the amount of buys just in the most recent quarter, 79 billion worth of buying, 30 billion worth of selling. Now, the intrinsic value of $230, we can show you the growth rate used. We use 20% moving forwards on the lower end today to be a bit more conservative, that if you believe 25% to be correct, $325, and you can also see the high growth rate. So based on the 20%, we do see 230 around where this company does sit, and if you use a margin of safety today, at the 10%, not far off at $207, $208, we do believe this company is a buy. Again, bear in mind, that is if you see this as a high quality company, wide moat, strong financial metrics, and good forward looking data, which we believe you could tick all three for the company. Wall Street themselves see this at 24% upside, a little bit less than Microsoft's 27. They see this at $265 over the next year. And again, all of these, according to analysts, should continue to outperform the S&P 500. We then move on to Uber, which is pretty much flat over the last year. Just over the last week, though, it is down around 5%. And if you've been a longer term shareholder, you'd be up nearly 100% outperforming the S&P. And we can see it's trading in the mid to upper end of the 52-week range. We see the all-time highs around the $87 mark, with another very impressive rating summary, strong buy from Quant, and a double buy from Seeking Alpha on Wall Street. Bear in mind, Wall Street 4.47, not far off at all the 4.5, that would flip them into a strong buy. Now, for those that don't know, it was just announced not that long ago that Bill Ackman is gathering a very large position of Uber in his portfolio, currently sitting at just above $2 billion, and he believes that even right now, at the price it is sitting at, it is trading at a massive discount. If we look at their earnings, we can see they've outperformed 3 of the last 4, with their most recent one being a massive beat of $2.73, $2.43 EPS target for this year. It is trading at a valuation of 32.5. Now, in comparison to others, again, we are talking about a company that's trading at a premium, 19.2 for the sector, so you're paying around 25%, and again, something consistent overall in terms of the other valuation metrics. In terms of the growth, though, they do look very strong at an A, 18% year on year, forward looking 16%, a lot better than the sector at the mid-single digit, but slightly lower than their own historicals of 34 and 27% respectively. They are anticipated to grow quite significantly the earnings per share, 34.5% over the next 3 to 5 years, with the comparable for the sector coming in at 11.7, and we also like their profitability at an A+. Gross margin 33%, better than the sector at 31, pretty much in line with their own 5-year at 34, and bottom line 23%, sector at 6.5, and we can see over the last 5 years they've actually been reporting a loss, negative 22%. Cash from operations also very strong, just over 7 billion, sector comparative at 346 million, and in fact their own 5-year average a lot lower at 220 million. In terms of institutional ownership, 80%, 12 million worth of sales over the last year, nearly double the amount of buys at 22 billion, but we also notice, like the other 2 stocks today, institutions in the most recent quarter were buying a significant amount more than they were selling. Our intrinsic value, $105. As you can see, we would say we've gone on the more conservative estimate at 10%, but upside is still shown whether you use the lower or higher rate today. And in terms of a margin of safety, maybe the highest that we will get to in today's episode, that you can in fact see you're getting at least 25% up to $78, at 30% around the $73 mark. So with that 25% MOS, Wall Street do see upside 21% over the next year. Their price target is $92, and as we saw, Bill Ackman does believe even the price around $75, this company is trading at a massive discount. We then move on to Salesforce, which is up around 9% over the last 12 months. Just over the last month though, it is in a downward trend, negative 8%, trading in the midpoint of the 52-week range with a buy rating from Wall Street, and it does pay a dividend at 0.52%. If we look at their earnings over the next 4 quarters, growth is anticipated to each one, and over the last 4 they have a 75% track record, missing their most recent target, with January 2026 giving this company a valuation of 27.63. In terms of the sector median, it does sit a little bit higher, so yes, you are paying a 27% premium, but over the last 5 years, they have sat around 27% higher in terms of valuation. Again, constant theme pretty much across all the stocks today. They do trade at a premium to the overall sector, but actually they trade lower than their own 5-year average. In terms of growth, B+, year on year and forward looking around the 10% mark, sector in comparison sitting at the mid-single digit, but we do notice over the last 5 years they have been growing at a faster rate. In terms of EPS, 18.3% over the next 3 to 5, which does sit above the sector comparative at 15, but it does sit a little bit lower than the historicals of 20.3. Profitability looking strong at an A+, gross margin 77%, a lot better than the sector at 50, higher than their 5-year of 74, and bottom line 16%, again a lot better than both comparatives. They have really been improving on their efficiencies over time. They also generate significant amount of cash from operations, $12.5 billion, sector at $100 million, their own historical average at 7.25. When we take a look at the valuation of this company based on this metric, what we do notice is right now it is sitting at the lower end, in fact if not slightly out, which does give us that undervaluation signal. As we also highlighted earlier, the company does trade below their own 5-year average. And finally, when we do look at institutional ownership of 81%, $23.5 billion worth of sales, but more buying 30.4, and again more buying than selling in the most recent quarter. So let's talk about the valuation. We get to $372 today, where in fact in terms of a low, medium and high, we've gone for the medium of 12%, which does give upside. Again, so does the high, and the low one around the 4%, which pretty much means right now baked in the numbers is a growth rate around the 9% point. In terms of margin of safety, at 10%, a buy at 334, at 20%, not quite there yet, so you're getting somewhere between 15 to 20% for Salesforce, high quality company, with Wall Street seeing this near the $400 mark over the next year, translating to 28% upside. As always, give us your thoughts about the overall market, the direction you believe it's heading in, as well as whether or not any of these 4 quality stocks are on your watch list. Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon as well, where we do cover our weekly buys and sales, and we have been buying and in fact selling given the volatility over the last week. As always though, have a great day and we'll see you all on the next one.